Hey, what's up guys? John here. Are we in a silent depression far worse than 1929? Millions of homeowners and property owners and Americans would probably agree that we are. But let's look at the real numbers. This viral TikTok came out last year. But why am I sharing this last year? Well, because right now, millions of Americans are looking into refinancing their homes, getting out second mortgages, trying to tap into equity to survive. This is all new. This is the last week or so. Now that rates have dropped, people have some breathing room.
The interest rate for the most popular U.S. home loan plunged to its lowest level in 15 months.
Now to a drop in mortgage rates and home prices in many parts of the U.S., bringing some encouraging news for home buyers.
And they're wanting to tap into this equity to try to pay off credit card debt and auto loan debt and trying to really get themselves out of a bad situation. But look how far we've come. In 1930, the average house was 3 times annual income. Now it's 8 times annual income. A car was 46% of income. Now it's 85% of someone's annual income. Rent, $216 a year, 16% of income. Rent now 42% of income. Income was $1,300 a year. Now it's $56,000 a year. So CNBC says no, there's no way that this is possible. Because, what they suggested was today, life expectancies are much longer. The quality of life is much better. And the opportunities to realize one's potential are much greater. Human rights are more widely respected to access the information. Education is widely expanded. But yet they don't tap in to the real numbers. The numbers are what people are feeling today. They're not tapping into the numbers because they know the numbers indicate one thing, that it's very, very, very challenging out there and we're not in this great job market, this great economy. Unless you're an investor. Because if you're an investor, you're going to see a lot of opportunity. A lot of assets are about to trade hands over the next year, 2 years, 3 years. In this video, I'm going to show you exactly where Americans are right now, exactly what's happening in real estate, and exactly what you should be doing to capitalize on this changing economy. Because if you're not, someone else is. Likely a private equity firm, an institution, deep pocket investors. They're going to be capitalizing on it regardless of everyone's opinion. We're in the great transfer, the great wealth transfer. It's happening, started in 2020, and it's going to really start happening in the next couple of years. Please hit the like button. Hit the like button, YouTube will share the content. Educate more people about what's going on in our economy, in our world. If you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call tomorrow, and check out our reviews on Trustpilot. Take a look at this. This is wild. Today, August 7th, homeowners are flocking to HELOCs. Watch out for these pitfalls. Well, I have a belief that, and it's 11.5 trillion in HELOCs. Bloomberg, more Americans are tapping home equity credit lines. Now, I have a feeling that what we're going to start seeing is this great rug pull on all these mortgages. We're going to start seeing, and this isn't an opinion. Look at this first. Weekly mortgage refi demand soared 16%. Now, you can look on Google Trends. You can see where we are now compared to where we were in 2008, 2009, 2010. There's a significant demand for money right now. HELOC loan rates, HELOC requirements, HELOC versus home equity loan versus HELOC, they're all breaking out. Now, what's going to be fascinating is this $3 trillion pool of cash that's going to be hitting homeowners' pockets. But is this money free? Is this for the betterment of these homeowners? Or are these homeowners about to get rug pulled? Now look at this. $3 trillion could be injected into the U.S. economy without any federal spending by tweaking this corner of the mortgage market. Now, they're going to start small. They said they're going to start somewhere, around $1 trillion. They're going to start with $1 trillion into consumers' wallets as soon as the summer, but $2 trillion more by the autumn. So $2 trillion by the autumn, potential stimulus could top $3 trillion. So it's going to be home equity lines. Home equity loans, which would come as banks have slashed their participation following the financial crisis. So they're going to come out there and they're going to be issuing these HELOC loans, $3 trillion worth of HELOC loans. Could you imagine? As this job market's changing and things are just getting worse and worse and worse. Look at this. Job growth totals 114,000 in July, much less than expected. As unemployment rate rises to 4.3%, the average premium on insurance up 33% from 2020 to 2023, right? This came out, about a month ago. Then property taxes up 7%. They collected $363 billion in property taxes. So what I think is going to happen, even electric bills in Florida, for example, in a single year, the average Techco customers saw their annual electricity costs rise by $492. That is crazy. Even grocery store prices up 24.7% since 2020. Now, what I think they're going to do is I believe we're going to see the money printer turn back on, except, and some would say it's already on, John, but this time it's going to be towards home equity lines of credit. It's going to be, these, stimulus packages, these subsidies, these programs, and we're going to just see more and more and more money flowing into the system. And this money is going to chase assets. That's what's going to happen. And these homeowners that, they have this house they think is worth $500,000. In reality, if it was a free market, it'd probably be worth $300,000. But, there's so much money out there chasing it, they'll get that loan, and they'll get that loan, they'll get this loan. And what's going to happen, they're going to lose their job and not going to be able to make the payments. And so they're not going to be able to make the payments. What will then happen? They're going to have to get the keys back. That's what's going to happen. And so right now, people are being pushed into the corner. They don't have a choice. They don't have a choice. If they were to sell their home outright and they would go rent, is that really the solution many people want? No, right? They want to hold on, hoping the storm's going to be over. But look, we're 5 years into this, almost 5 years into this problem. And looking back, 2020 to now, 4.5 years in, does it look like things are going to go back to 2018, 2019? To me, no. To me, it looks like things are gradually getting worse and worse and worse. So if you are paying attention to these numbers, you'll see that there's just no doubt that consumers are going to be left behind. Look at this, most consumers. The survey found 37% of Americans are behind on monthly bills. 37% of Americans. So you take in all these rising costs, and median household income has fallen. 2019 was $78,250. Now it's $74,000. So you have real wages falling, $5,000 per household across America, but yet the cost of insurance up 30%, groceries up 25%, utility bills up dramatically, taxes up 7% just in the last year. You have all of these increases across the board, and then you have job layoffs that are now really starting to pick up. What's going to be the natural chain of events? Natural chain of events are people are going to borrow as much money as they possibly can, and then once they can no longer pay it back, they're going to have to give the keys back. And that's what we're walking into. That's why you look at some of these really big, private equity firms and these endowments, these pension funds, sovereign wealth funds. They're all looking at real estate. They're all looking to protect their cash. You look in the money market accounts, there's over $6.4 trillion in cash. Warren Buffett's holding more bonds than the Federal Reserve itself, right? They're all flocking to safety. Why? Because if small and middle class business owners and everyday Americans can barely afford to keep the lights on, then what are they going to do when push comes to shove? They're going to be forced to sell off stocks and give the keys back. And at that point, he or she who has the cash makes the rules. And when this is all happening, a buyer basically sets the price. Even in a healthy market, a buyer sets the price. But in a really, really, really challenged economy, where there's a lot more sellers than available buyers, the price is going to just continue to fall. So I believe we're going to step into this unique scenario where over the next year or so, we're going to see more and more and more people flocking to HELOCs and all these different types of loan products. But then they're going to see that, hey, the world's not going to get any better. The world's actually going to get worse, because we're also moving into an era with automation, job outsourcing, where, before America was the land of opportunity, where everyone wanted to come to America to find a better life. But now, over the last 4 years, what's unfolded is a lot of these opportunities are now universal. They can be outsourced. They can be automated. And so when you just start looking at the real numbers, we're going to walk into a period of massive disruption. And I think that inside of this period of massive disruption, if you're an entrepreneur, a business owner, there's going to be a lot of opportunity for people out there ready to chase it. The ambitious are going to thrive over the next few years. But those that believe that this HELOC or some of these other loan products are going to solve the problem, I personally believe that when they're throwing $3 trillion into it, I don't think that's going to be a situation that's going to be for the betterment of most Americans. It says the U.S. housing market is harboring the potential of unprecedented economic stimulus that wouldn't require any federal spending. While she has recently warned that the dangers of the crisis of the American male poses to the economy and the housing market, the CEO of Meredith Whitney Advisory Group highlighted the opportunity that a proposed reform to the mortgage market could represent. In a column, the Financial Times on Friday, she noted that mortgage finance giant Freddie Mac asked a regulator last month to enter the secondary mortgage market or home equity loans, which allows homeowners to borrow against the equity in their homes. Such borrowing can be used for things like vacations, weddings, new cars, investments, medical bills, paying down debt, or starting a business. In other words, it's more money that could power the economy. Freddie Mac is best known for its role in buying first-time mortgages, pooling them together, and selling them to investors as mortgage-backed securities. This allows lenders to get those mortgages off of their balance sheets, freeing up liquidity for more loans. You start to think about how crazy this is. How crazy this is. What do you think about this entire situation? What do you think is going to unfold in the U.S. housing market? Do you think they're going to continue trying to prop this up? Because the higher they say property values are, the higher taxes are going to go, right? The more that people are just going to say, okay, it's just a little bit longer, a little bit longer, a little bit longer. Versus in 2008, when things hit the fan, there was massive panic. Everyone was covering it. All the media outlets, it was crazy. And because of this, it forced massive sell-offs. But now the conversation is, unemployment is only 4.5% or 4.2%, 4.3%. And inflation, is very, very low. Everything is really, really good. You look at the numbers say otherwise. What do you think about this entire situation? You think we're walking into a massive opportunity inside of the real estate market the next couple of years? Let's have a conversation below. And if you'd like to fix your credit to position yourself for what I think is going to be way bigger of an opportunity than 2008, we'd love to help you. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to greatcreditfast.com. You can click the link in the description just below this video. Schedule a free call for tomorrow. You can check out our reviews on Trustpilot as well. Catch you next video.